a premier financial services holding company in Nigeria. So this is a bit about First Holdco. First Holdco is the parent company to the First Bank Group. That is First Bank Nigeria, First Nominees, First Pension Custodian, as well as international subsidiaries across Africa and Europe. Within the group, we also have the Investment Banking and Asset Management Group, which consists of First Trustees, First Asset Management, First Cap, as our investment banking business, and First Securities Brokers, our equities trading business. Also within the group, we have First Insurance Brokers responsible for insurance brokerage, risk advisory, as well as risk management services. So today, for those that may not know, the Leading Conversations webinar series brings together industry experts as well as subject matter experts to discuss topics that impact wealth creation, multiplication of wealth, very important, safeguarding the wealth that has been multiplied, and then transferring this wealth to generations to come. Today, the topic we'll be discussing is estate planning and the new tax law. What still works, and by extension, what will be no longer apply. Yes, it's very important. So, my name is Ndubisi Okwini. Let me take it again. Smooth. My name is Ndubisi Okwini, but please call me Andy. And I will be your moderator today. I will guide the discussions so that at the end of it all, not only will we understand or refresh our memories as to what estate planning is, but in the context of the new tax law, we will be better informed, right? And we have a solid team today. Trust me, guys. Industry experts, the saying is years of experience like here. I think altogether we are close to 35 or more years of experience. Should be more. We should be privileged. So we are ready. We're good to go. So today we have Sarah Naiju. I got that word. Very good. We have Sarah on the call. Well, here with us, brother. She's a graduate of economics from the University of Manchester, UK. She's a fellow of the Chartered Institute of Taxation of Nigeria and a member of the Institute of Chartered Accountants of Nigeria. She has over 16 years professional experience in tax consultancy and regulatory practice in Nigeria and the United Kingdom as well. Sarah is an associate director in the tax and regulatory framework function. You know what you're getting? Function at Deloitte, Nigeria. She currently specializes in managing cross-border tax compliance for individuals and has managed numerous complex projects around payroll management, compensation and benefits restructuring, and advisory services to multinationals, SMEs, high net worth individuals across all industries and sectors. Sarah has extensive experience in understanding business needs and enjoys traveling and mentoring groups in what she calls sessions with Sarah in her spare time. Welcome, Sarah. You can go back, please. Also with us is Rotimi Obinde from the New Face. Rotimi is an associate director and heads the private trust business at First Trustees, a fellow of the Institute of Chartered Accountants of Nigeria. Rotimi holds an MBA from the University of South Wales and a BSc in accounting from the University of Leeds. Rotimi has extensive experience in strategy development, financial analysis, financial planning, research, and estate development. Over the last 16 years, Rotimi has been involved in managing clients' trust relationships with particular focus on generational wealth transfer and succession planning. Rotimi enjoys swimming, playing football, and presentations such as this. Welcome, Rotimi.
Thank you very much, Andy.
Finally, and definitely not the least, we have Thelma Japona. We'd like to call her Jackie. Thelma is a legal practitioner and a private trust specialist at First Trustees Limited, with over 5 years' experience in estate planning, trust structuring, and wealth preservation advisory. She specializes in implementing bespoke estate planning structures aimed at safeguarding assets and ensuring a seamless intergenerational transfer of wealth. Her expertise spans detailed and strategic analysis of complex matters relating to estate administration, judiciary arrangements, and wealth management solutions for individuals and families. Thelma is also a member of the Chartered Institute of Arbitrators, United Kingdom. Outside of professional engagement, Thelma has a keen interest in fashion and fitness, reflecting her appreciation for creativity, discipline, and balanced living. So, Northie, welcome. Sarah.
Thank you, Andy.
Okay, so we have met you guys, we've met the panelists in time. I know that we are all familiar with webinars and virtual meetings, but for completeness, let us remind ourselves of the 3 things. So first of all is that we have 2 chat rooms. There's a regular chat room where you can exchange pleasantries, drop ideas. If something jumps out at you that Sarah has said, you can note it there, share insights, and just banter generally. And then we have another chat room, it's the Q&A chat room, designated for questions only. So please, areas are not clear to you, may need additional clarifications on, please post those questions in the chat.
Was
The meeting is scheduled to run for 60 minutes. And within the 60 minutes, we have about 3 sections. So the first is, Sarah will run us through the new tax law, things to note, things to be aware of. That will take about 20 minutes. Then we'll now go into the discussions, where we will deliberate estate planning and impact of money tax laws. Once we've done the written, we will go into Q&A, where we'll take questions from the audience and for us to clarify areas that may not be super clear on our side or on their side rather. And then thereafter we'll wrap up very quickly. So for some under 60 minutes we are done with it. But please note that during this session we will have 2 polls that will run simultaneously. We will run at different points. Yeah, they're not tedious, just very quick polls. 10 seconds, 30 seconds, and we are done. So that's it. At this point, we're good to go. But before I pass the mic to Sarah to run us through the presentation, let us take our first poll. So, admin, if you could help us, please put up the poll now. Quick poll, 30 seconds, and we are done. Exactly. I don't think it's a right to make wrong answer. Just answer like this, and I will hit okay. So we have the results now. Okay, we'll come back to the poll much later. Let's just dive into the presentation. So Sarah, please pick up the net and run us through your presentation for the next 20 minutes. You can be for less time, but 20 minutes is the target. Get for it.
Thank you very much, Ed. Thank you, Trustee. Pleasure to be here today. I did see some comments on audio, and I'm going to try and project as loud as I can. So for the next 20 minutes, we'll be speaking through now how the new tax laws actually impact the trust setup. And perhaps maybe just to set some general basic knowledge on around when we're looking at a trust, so looking at the different parties, we'll look at the specifics for each actor, if I can put it that way, within the trust setup to see what are the tax obligations, what are the risk elements, what are the practical best practice approach to gain compliance for each of those parties. Now, the reason why we're here is because we have a new tax reform law that, of course, came into effect effective on 1st of January 2026. So we call the Nigerian Tax Act, the Nigerian Tax Administration Act, the Nigerian Revenue Service Act, the Joint Revenue Board Establishment Act. guess the focus for today's conversation would really be on the first being the consolidated law that has all the basics around what income should be taxed, who should be taxed, what are the rates, and those specific clarification around the tax law. And while the NTAA, as we call the Nigerian Tax Administration Act, speaks to administration as it says, penalties, timelines, which authorities collecting what. Now, when we look at the Nigerian Tax Act, these are the terms of persons. And so when we say persons with respect to the tax law, what you have on the screen are the terms of persons that are subjected to tax. And when you talk about individuals, so whenever you hear the tax law refer to individuals, we're looking at individuals in the real sense of it, sole proprietors and both body of individuals, communities, we're looking at companies, and then we're also looking at trustees, executors, and any other legal arrangement, which is, of course, the reason why we're here today. So the focus of the conversation, like I said, is going to be around the trusts, the trustees, the executors. And I just wanted to quickly go through, key definitions for us to see where we fall within this whole spectrum. What is the persons that form a trust? So the trust itself, the legal arrangements, where the trust, the settlor would transfer the assets to a trust. We've got the settlor being the person, the individual that is actually creating the trust. And then you've got the trustee, being the individual or corporate, or sports trustee in this case, that's appointed by a settlor to hold the title to the assets within the trust and, of course, in charge of managing and administration. We've got the executors. So again, the person that is executors usually come up in the case of when you have a will. And most importantly, the beneficiaries, because I'm sure they are the ones that are really concerned about which part of my money or the funds to come to me is actually going to land in my pocket and which part the tax authorities are going to take. So just bearing in mind that these are the 5 terms of the categories of persons that you will hear the tax law refer to. So when we speak to income charges, because again, when you look at any set of the tax law, taxes are on income, not on individuals, it's on income. And so for every conversation with the tax administrators, they're really trying to determine, is there an income? And where there's an income that is generated, there are, of course, taxes being there. And the tax law will specify the classes of incomes that are chargeable. And so when you're looking in a trust setting, we want to see within the trust arrangements, are any of these incomes part of the incomes that is carried by those assets within the trust or the persons within the trust arrangement? So profits and gains from trade, business, trade, or vocation, with rents, royalties. So if there are properties that as part of the assets class that is being rented, so you're thinking the rental income from all of those. If they are payouts in forms of maybe their investment, their equity, the shares, so they have dividend payouts, dividend income, interest incomes. You have like fees or other income that is derived. So if they're like management fees paid, maybe those are income in the edge of the management, either a person or a corporate. So if there are gains, capital gains on disposal, or either the trust or the estate property. So if the trust is on its own, if the asset fund is sold and of course sold at a profit, then below there's a capital gains there, meaning there will be income on that day. Right. And any other income that is derived from the trust or the entire estate. So whenever there's an income that is generated from a form of activity that is earning certain income, and there will be tax, basically. Now, I guess what we will then share light on is who is going to carry the tax obligation and what has a tax burden, and how that will increase and flow through the entirety of trust arrangements. The tax law was clear, and this is where, of course, the NTA was in, that it will only be assessed to income based on attribution. And so we will be looking at each party within the trust arrangement that is receiving the income and in whose hand those incomes will be subjected to tax. So whether it's the trustee, whether it's the executor, whether it's the settlor, those will be the focus of our conversation today. But for as long as there's an income that's flowing to those parties, there will be tax. Just setting those ground rules. Now, similar to every taxable person, whether you're an individual or company, the tax also provides certain expenses that are deductible. So if it's the trustee that is earning an income, then there are expenses that are also claimable as allowable deductions to reduce that income to arrive at what we call the taxable income. And I'll explain that a bit later. Right? Because the way tax works is you have the total income. So those incomes I explained earlier on. You have deductions that you can use to reduce those income amounts. You also have reliefs that the tax law does provide. It's the remainder, which is after you remove the deductions and the reliefs, that we then call taxable income. It's that taxable income that we then start applying the tax rates to. So you have the graduated tax rates for individuals, and you have those 30% for large companies and the likes. So when I say income, it's not the income amount that gets reserved in tax. It's the remainder taxable income that the tax rates will be applied on. So coming back to the conversation around expenses. So any expense that is incurred wholly and exclusively in producing that income, that's allowable as an allowable deduction. And so if you look at the trust setting, and I'm sure Rotimi and Thelma will probably shed more light, just to give some sense of the different forms of expenses that imposes incurred by even in the trustee setting. If they are remuneration, so same way companies have like salaries they pay to staff costs. So if there are remunerations given to even should I call it the employees of the trustee as well. So those are deductible expenses. They can have administrative and management expenses, legal and professional fees. If there are charges on the trust properties, those rates and taxes that are statutory, those are allowable deductible expenses. If there are those investments, and in setting up those, if you have maybe portfolio values, annuities, and maybe there are some charges that are related to them, those are expenses that are incurred to generate whatever the return of those investments will be. And of course, in the event of that, no Thelma actually ran me through this a while ago. So expenses, when you have like execution of the deed or the will, so there are some of those ancillary expenses that are associated. Those are deductible expenses that are also recognized in the tax law. A key change that's also going to form part of our conversation is it's now more important than ever to assess the residency of each of these parties, whether it's a trustee, the beneficiary, the settlor, or the executor. Because tax rules now is based on the residency of either of these parties. So once any of those parties deemed to be resident in Nigeria, then you have an exposure to tax. If you're a non-resident individual, so if you do not meet the residency rule and you're considered not resident, then you will also speak to what portion of whatever income that is attributable to you as party to the trust will be subject to tax. And I'll also establish some exemption. So I'm just going to run through this because this is very important as we go along. For individuals, before, you had to be physically resident. Everybody used to know the 183 days law. And that's no longer the case. There are specifics on how you assess an individual to tax in Nigeria. The residency rule has got two conditions. So you can domicile in Nigeria. If you say Nigeria is your country of residence, and the citizen of Portugal. So that's why, yes, you say the citizenship will. Once you're a Nigerian citizen, there's a likely chance you're exposed to tax in Nigeria. If you have a permanent place available for your domestic use, so you have a place that's ever rented, but it's you using it arbitrarily. And that's why the third one also comes, place of arbitral abode. Could be in your rented in your name, it could just be leased in your name, it could be that it was owned by you. So long as you are arbitrarily resident in that place, and that place is located in Nigeria, that could easily make you resident, because then you fulfill that condition. If you've got substantial economic and immediate family ties to Nigeria, you're resident in Nigeria. And of course, the 183 days rule was equally retained. So if you're in Nigeria for 183 days or more, you are considered resident in Nigeria. Now, there was for those in employment. As your duties of employment is only a party between in Nigeria, and it's also seen that you're not being taxed anywhere else in any other country. You will be deemed to be resident of Nigeria. Recall I said when we say individuals, we meant trustees and trust as well. So when I say resident individual, just to know that all those parties to the trust are considered individual on that aspect. Now, of course, there's for resident company. This is really just for general knowledge, because again, companies also access whenever you have the limited companies, PLCs, it is formed or registered or incorporated under any law in Nigeria. That entity is deemed to be a resident company for Nigerian purpose. When the central place for management or control is in Nigeria, due to be resident Nigeria. And when you've got effective place of management or control is in Nigeria for any more than 12 months period, that entity will be deemed to be resident Nigeria. But why this is important is because once you're resident in Nigeria, you have a tax exclusion. And they will now need to now look at, once you're resident, we look at your worldwide income. That's what the NTA says. Wherever you're earning the income from, wherever it's paid to you whether it's paid to you while you're in Nigeria or paid whilst you're outside Nigeria, or if you're physically in Nigeria, maybe you received it in a foreign bank account, because that income was paid to you and you are residents, it will be assessed under the Nigerian tax system. And they will then need to now start looking, okay, once at least allowing you deductions like I mentioned for you as a person, because individuals also can claim any expense holding or exclusively incurred to generate those incomes. And we start looking at those specific reliefs. We saw a lot public career with it, pension reliefs, the national single contributions, life insurance, just specific reliefs in the tax law. We then start looking at all of those deductions and reliefs to reduce that taxable income that I said the rate will be applied on. And look at specific provisions in the law. For certain classes of incomes are equally exempted. Okay, we have 20 minutes, so I can't go into full-on teaching, but it's important to then see that once you meet the residency criteria, you want to be familiar with those the exemptions, those reliefs and deductions, because that's the only way you can then reduce your taxable income and enforce your tax burden. So we will then go into the different parts and specifics. How is a trust tax? And looking at the tax law. And like I said, when you speak tax, it's not based on an opinion. We have the Nigerian Tax Act. It's not like they call the tax Bible, where it specifies the provisions. So yeah, section 3, section 4, section 16, and even the fifth schedule to the NTA, that's the legal basis. We see all the provisions for how the trust should be serviced. But like I said, any income arising from that trust, which is taxable in Nigeria. So we then need to know, is this trust registered in Nigeria? Does it meet those residency law? Once the answer is yes, then you know the trust, the income generated from it, Nigeria is going to be involved in the taxation, which we then start looking at those assessment criteria. When we say the liability of the trust does not automatically rest on the trust itself, so we then look at those distribution provisions. Now, like I said, persons that are chargeable to tax under a trust is dependent on who has control of whether it's the assets, who has an entitlement to some of those incomes of the proceeds, and of course when it says statutory dispute attribution, so whether it's by will or by the settle would have actually indicated. So you would give the more technical terms. And so taxation may arise in the hands of settled beneficiary trustee, just like I mentioned. So the trust itself is not it's not a person, it's now the trustee, the settled beneficiary, and those three are equally important. Remember, I also mentioned when we have those unique students. So it's to then see rules, what are the attribution rules for those individuals. So then you look at settlers for instance. Now the settler will be subject to tax when you have this revocable provisions. So if the trust is revocable in the sense that the assets, if public apparently if I get this wrong, the assets and what the trust comes back to the settlers. So of course not by way of maybe death when you're going to share it, but like it's the trust is it's worded in such a way that the ultimate owner is still with set. Then yes, the settler will be the one responsible for taxes. And so attribution rules always state that whenever that settler is still retaining control and power over the trust assets or the income of the trust, then the obligation for tax withholding will remain with the settler. I saw it. And well, but where those people will come to the trustees so that I don't mix it up with everybody else at all. Now, when the settler is benefiting directly or indirectly from the trust, there will be some income that might actually be directly attributable to the settler. Remember, I said is whoever is getting the income. So if the way the trust is set up that the settler still gets some, then as well the settler will have to be accountable for the tax of those income that is attributable to him or her directly. And you also have those instances where the beneficiary could be an unmarried child. So whether an infant, in those cases, the settler will still be the one responsible for the tax on incomes attributable to the child or the child for the children. So I hope those that settlers in this court are actually taking notes so that you know where your obligation starts and ends. Another key thing to notice for the settler is now when you're looking at the unmarried children section, if the income to those unmarried children is below the minimum wage and national minimum, and of course real taxes, because they still enjoy the full former exemption on the national minimum wage. But if the income to those unmarried children is above minimum wage, then of course the excess, the income now becomes subjected to tax. Like I said, the settler is now responsible for that. Now, when you look at for beneficiaries, I think beneficiary is the easiest one. If you're a beneficiary to a trust, just know any income that is attributable to you, then you as the beneficiary, you are liable to account for the tax. Then as the beneficiary, you then need to look at, am I a resident in Nigeria? If the answer is yes, if the trust is even registered somewhere outside Nigeria, but you meet the residency rule, that income from that trust, you would have to subject it to Nigeria tax. But if you're non-resident as a beneficiary, then you then look at the income from that trust. You have to be income that was from a trust registered in Nigeria or was brought into or derived from Nigeria. So we need that source for you if you're a non-resident. But once you're a resident, it's worldwide. Wherever the trust is, wherever the income is flowing to and fro, you as a beneficiary risking that income will be considered transfers. I guess then for the trustee, which is why some of us are here today, that if there's no attribution to the settler, and I think maybe it's probably a timing that you can probably shed some more light on. Because when there are no income that is distributed to beneficiaries, and maybe it's a timeline of nobody is entitled to some distribution yet, and the administration and the control still rests on a trust stage. I'm not sure how that works, and you probably can dive in so that I can then speak to the tax points. Now, during the administration, the executor will then be assessed on income that arises from the estate. So if there's no payout and the control is still with the trustee, then of course, trustee has the obligation to account for those income, those expenses, and then the leftover taxable income or taxable profits, whichever one you want to call it, then needs to report it and of course file to the relevant tax authority. Now, taxes will be of course computed at that point. If that process happens before distribution, then of course at the point of distribution you can offset the tax across board, because really the incomes was really for settler and the beneficiaries, again depending on how the different trust arrangements. But if it's a timing thing where the income at the point of payment and generated, then yes, the trustee will have the obligation to account for whatever taxes arise. It's because the settler and the beneficiaries will only be able to account for taxes when they receive distribution by the trustee or from the trust was and by the trustee. I'm being told I'm running out of time, so I'm going to do this in the next 5 minutes probably. Now, there are considerations to also put in place. So that was mentioned. And maybe for us, probably keep this part of the administration of the estate and capital goodies. So similarly, like I said, if you have those gains like incomes, then we need to then of course be sure that you have taxes. So just display what the income tax rates are. So we now have a graduated income band starting from 0% to 25%. Was for incomes above 50 million. These are annual figures, annual rates. Incomes above 50 million naira per year, things beyond the above 25% income tax rate and band. So just be familiar that the individuals within the trust sector, so we said whether it's the beneficiary, there's an individual, whether it's a trustee or the sector, once you are in an individual fund, these is in tax rate that will apply to such persons. There are specific exemptions in the law that we have. Again, probably don't have enough time to go into it in detail, but yes, there are specific exemptions around chargeable gains. So whenever there are all the sale of assets, thresholds around that, and specific withholding taxes, tax rates on those distributions, whether it's a dividend and interest at 10%, whether it's the rate filing is. So there are specific withholding tax rates for the different transactions. So being familiar with those transactions. One advantage of NTA is that it sort of provides more clarity. It's a more detailed one at what price the tax will occur, income-wise, and also specifies those different incomes. It also specifies who is going to be subjected to tax when you have those unmarried children or when you have the unmarried children case. And it also spells out even specifics around whether it's a legitimate child or it's a step child. It was actually very clear. So that clarity was brought into play by the NTA to also dictate, okay, at what point is it the settler's responsibility? So that settlers don't just automatically think it's a trustee's responsibility for some arrangements. And being aware at this point is the settler's responsibility, this is the trustee's responsibility on taxes. We still have penalties. Penalties are more stringent under the NCA, so it's advisable to be compliant. So if any of the beneficiaries settlers, if you're not registered for tax, their penalties are 50,000 naira first month and 25,000 naira for each subsequent years. There are penalties for failure to file returns or if you find an incorrect tax return. With the penalties for implementing proper records. So record keeping is very important to keep track of those incomes and keep track of even the expenses so that you can reduce the income liability, the tax liability. There's penalty for if you fail to pay taxes on time. So 10% when you're unpaid and interest and prevailing CBN monetary policy rates. That can be high. So there's also, if you fail to provide documents when being asked by the tax authorities, there are just different penalties. Even for the trustee, whoever you're doing business with, they get penalties for doing business or transacting with a vendor that's not registered for taxes that go into 5 million. So being familiar with different penalties and knowing that it's actually less costly to be compliant. So again, the trustee and the executors, their returns to be filed, maintaining proper records, deducting those withholding taxes when if it's all these dividends, rental impact that's being paid out, if it's interest, and also responding to queries from tax authorities. Because again, sometimes it's a trustee that probably gets some of those correspondence with respect to some of whether it's a settlor or the beneficiary. So responding on time because they now have strict timelines for if you don't respond within 90 days, it becomes final and conclusive. So timelines are even more important in this administration. Once there's no response from either the taxpayer or the tax authority, the final assessment that was in place before the 90 days becomes final and conclusive. So you want to be sure that that final assessment is in the benefit of whether it's the parties to the trust and not to the tax authority at all times. So avoid getting into those space, being compliant, knowing the tax points, and of course, keeping good record about income allocation to the different parties. So I'm going to rest here so we can have enough time for specific comments and of course for our discussion. So thank you all for it.
Thank you very much, sir. My Lord and my God. That was a lot to take into, but I'm happy we had this conversation. Clearly, there's a lot to this. And maybe one session will do justice to this, maybe repeat session, or we could break it down into additional series, who knows, so that we can address each portion clearly and everybody understands exactly what to do, where to do, especially when, and how to do it. So I'm not the expert here, but this is what I took away from the lecture. So first is that the income, not all income, but the taxable version of the income. After you've taken out the expenses associated with generating that income and all the release that you can get on the government and the like, what is left is what is subject to tax. That's a good one. Second is the different parties tied to this conversation. They all have roles to play and they're all impacted differently. And then lastly, the third one, which is I'm not super clear on it yet, but I hope that and pray that clarity will come, is the residency piece. So even if I am abroad, but I've been here for 180 days, there's one tie that connects me to Nigeria, boom, I still have incomes. That's wonderful. If the trust is set up outside Nigeria, but there's one connection to me in Nigeria, boom, you are able to talk south, get t-shirts. Okay, so clearly there is more attention to how much the government can get from individuals operating within the country and all the benefits that come from those engagements. Okay, before we go to the discussions, because I know that we're giving you an item for it, let us take the chance very quickly. So, tech team, could you please put the poll up? And the next 30 seconds, we will close that.
Yep.
Okay. So the poll is up. Please, there's no right or wrong answer. Just feel free and respond.
So, it's other equals.
That's it. Time to vote.
Late. Hard votes.
This whole it would have been nice for us to be able to.
No, don't worry, vote after me.
You should.
So tech team, can we close the poll now? Okay, so the poll was around, do you know how the new tax law will impact your current and future income? 34% of attendees said yes. 21% not so clear. I mean, I even belong to the 21%. But I would like to know more, 45%. So this makes the case for in part two at this particular series. So watch out for it. Thank you very much for participating in the poll. So we'll go into the discussion thread. Let me start with, so it is safe to, no, it will not be safe to assume that everybody knows what estate planning is. And the different versions or tools or formats you guys are typically like, I'm just an Everton. So let me ask Thelma, right? Please explain to me, the 6-year-old, what estate planning is. I've heard will, I've heard trust, I don't know the difference. Is there a difference? Please help me.
Okay. So in life, there are things that refine you. So it could be one is in the bank accounts, it could be your vehicles, it could be investment and even jewelries. Yeah, those things which are true. Now, looking at those things, then start to think, we have revenues, right? How do we then pass all these assets to them? This is where estate planning comes into play. So estate planning is coming up with a structure that speaks to how you want all your assets to be managed during your lifetime and also transfer same to the beneficiaries when the creator of that estate plan is not well in the picture. Now, how do you achieve those structures? It's by using two major tools. So you either use a will or a trust. So now what is the difference between both? A trust arrangement is me saying, okay, first trustees, I want to come up with a structure, and I want to see the structure work during my lifetime. I have beneficiaries. I want to cater for their education. I want to cater for my special needs children. I have a charity. I want to keep that charity going, even when I am no longer in the picture. That is what a trust arrangement is. Now, for a will serves as an asset inventory. So, a will speaks from the grave. So, until the testator has passed, that is when distributions will take place. Now, what are the differences? If a trust is a private and confidential arrangement, so it is between myself, the creator of the trust, trustees, and another party, which is called the trust protector, that will be aware of that arrangement. Nobody else. Then for a will, it's a public document. I can go on Google and I can type, okay, I need this person's will and then to pop up. I can also go to the probate registry and request for the CTC copy of the will and to be given to, whereas that's a different for a trust. Another example is that a trust is very flexible. So I can tailor a specific need for myself. I can say, okay, I just want an education trust for my children. And I will see that happen during my lifetime. And I'll be comforting with that. Even if I'm no longer here, trustees will always carry out my instructions and cater for my children, even goes from one generation to the other. Whereas the will is an instruction, give this property to Andy, give this property to Thelma. That's what they deal with. Now, a trust is also not contestable. So no matter how disgruntled I am as a beneficiary, I can't look to court and contest it. But obviously, I'm not saying the arrangements because it's only the creator of the trust and the trust protector that are aware of what arrangement we have. And there are also restrictive clauses in the trust. Whereas for a will, as a disgruntled beneficiary in the will, I can say I'm not happy that he left me this little portion. I'm giving my siblings a higher portion. I want to contest it because it was not to be sound my I believe. So all of these are what an estate planning is, and typically we advise to have good instrument because there's certain things that can be in your will that cannot be in your trust. So that's
Thank you very much, Thelma. I like the last bit. I like the both of them. You cannot be.
yes, I have this.
Quick question. I'm
Yeah.
asking for someone about the trust. Are you have more than one trust?
So it depends. So you can say you just want an education trust and you want a charitable trust. For some people, they prefer to have them separately. But you can have a living trust that captures everything. A living trust can do charity, can do dedication, can do special needs, they can do any of those in one document. But for some people, they prefer that, okay, I have a group of rights. I want to set up this trust at alone lines. So I want a separate trust. I am an individual. I want a trust for my children and for my career.
Thank you. Thank you for clearing that. So I don't have to die for you to have a trust of
You don't have to die.
Thank you very much. So the living trust covers that for you.
Yes, and you can also do that with children so that it can be trust fund babies. I'm sure you've heard of that.
Sure.
Yes.
Yes, sir. So, what's your name?
Yes, I am.
So in the context of estate planning, Sarah has given those very solid lecture on a good tax words. But in the context of estate planning, where does taxation come in? Where? Especially from the client's viewpoints, where does taxation come into? What should I answer that?
Okay, so I would say that it comes in from the beginning. So when you sit with your professional, it's important to start to think tax, and that's been the missing gap all along because in terms of enforcement and in terms of the criminal acts, we have basically enjoyed those benefits, if I use that word. But as it is now, it's important that you start to think tax. And if you look at the definition that Sarah gave when she talked about income, you will realize that it is not just the money that you are making. So if your professional does not factor in expenses, you will pay a lot of tax. So as you're sitting with me, if I'm thinking of a will, I'll be saying to myself that, come, my executor must incur expenses. They must incur expenses because whatever the estate has made, I can't pay everything as tax. So as I'm drafting my will or asking my professional to draft my will, I'm saying, what do I want the estate to do? Maintenance of property. What do I want the estate to? I am not being directly involved in paying school fees for my villagers. I can decide that I'm beginning to pay jam exam or give scholarship. They are expensive because if you don't think that, you will pay a lot in terms of taxes. Remember that what is the taxable income is the income that the estate has made from a will point minus all the expenses that is captured. So it is not just the executor imagining it. To get to a point, the tax people will say, show me in the will that the will provides for all of this. And for those of you that don't like paying fees, you have to now start thinking about paying your executor's fees because it then becomes part of the expenses. On the trust side, you also will need to think. Sarah has talked about revocable and irrevocable, meaning you have control or you do not have control. So when you set up a trust and you say, Rotimi, go and do this, go and do this, go and do this, remember you have control. And because you have control, it then means that you should start to think taxes. Again, it will also be important that the object of your trust, which is how that trust is created, is able to then say that what are the things I want to achieve. Tema has talked a lot about education. So what's the clause around education? Who am I paying school fees to? Or what am I paying school fees for? Are they just my children? If I'm making provision for allowances for welfare, for example, I think government still does not be glad that minimum wage. So you need to be asking yourself that way to look at my child that I'm sending to this university. Does it then mean that in terms of welfare, I'm just going to be giving them 10,000 naira every week or every month? Because these things are they are important. Now, let me just quickly close with this so we can go into other conversation. When you then say, for example, that you want your aged parents to be taken care of, there's this bit around rental income. Sorry, not the rental income, what you pay as rent. It's important that if you, for example, you are looking at welfare, whatever you are paying as rent has to be captured, and it has to be properly captured. And it's then finally the responsibility of the trustee or executor to ensure that they do not get fined or penalized for things that either overlooked or the settlor or testator's have not then captured in their wills or in their trust.
Interesting. Thank you, Rotimi, for your insights. So let me move to Sarah. So the new tax law took effect January 1, 2026, yes?
So,
What about trusts that have existed before the date? What then happens to those kind of arrangements?
okay, so if you remember what I said, taxes are income.
Yes.
And so the Nigerian tax that is play on something. It's for transactions that took place from 1st of January 2026. So yes, the trust has been in place and it probably was already making some payments real time that's even into some of those unmarried children or where were payments to certain beneficiaries. Now, nobody was thinking tax. So yes, the trust is still live. But now for transactions and payouts from 1st of January 2026, you now need to start looking at it. Now these income chargeable, it's chargeable in whose hand? This in the beneficiary stands so you need to start informing the beneficiary. You have a tax obligation, and the beneficiary needs to be aware. If it's on the trustee's side, if it's those irrevocable one that is the power is still with the trustee, then the trustee needs to be conscious and Shopper's trustees are fine. So I'm going to give yours as a gift. So know that you need to keep those records, those incomes, those distributions, those expenses, and post filing obligation. Said laws like Rotimi also mentioned, if you know you have a revocable trust and you still have that control, then we need to be aware that in your name you need to start having those filings done timely, keeping track of all of those incomes. But like I also said, you need to make sure you're keeping track of those expenses because otherwise you will pay too much tax. So yes, transactions after 1st of January 2020. Even for existing trust.
Brilliant. It's good to know that what's before them. So it is just going forward. Okay, noted. Rosie, We know that it's safest from all the English that people speak it and all the technical terms that we find way over my head.
Right.
It's safest to speak with professional, in this case, first trustees. So we looking forward now. If I approach you, I'll say, first trustees, please help me. I want to set up an estate for myself and to 4 generations to come. Right? Guide me.
Okay, so 3 to 4 generations to come.
What should I be mindful of?
It's important that you consider large, you consider the size of the estate or the size of the trust that we are looking at. So when we are talking finance and we are talking wealth, there are HNIs, there are ultra HNIs, there are some people that are on our level, some of these small children. Now it's important because if I'm thinking HNIs and ultra HNIs, there are parties I would have to engage depending on the complexity of your estate. That was me speaking in Deloitte, for example. We say, come, let's have this conversation with this client, and all the tax implications will be spelled out before we then start to think what beneficiaries we get. Because again, double taxation has to be clear. I will not want a situation where you pay twice. But if the trust or the trustees able to then, based on that conversation with the client, be able to advise with the partners that we have, be able to advise or at that level, then beneficiaries, future generations will be taken care of. So for me, we can properly plan generational wealth transfer. It is not a problem. It has never been a problem. But there are now penalties involved, which as a client, you will need to be aware of. Even as a trustee, I don't want to be fined because again, I'm asking myself, who will pay the fine? Ultimately, it will be the trust or the settlor that will pay the fine. And so you see things are even in the trust, you start to see things like, if I tell you that you are due to pay this tax and you refuse, the trustee will go ahead, take that money from the trust and pay. If you then refuse, both the fine and the penalties plus the tax itself, eventually when the tax man comes, it is your responsibility. The trust will be responsible for it. So a lot of these conversations would need to have them with professionals, and it's not just from the trustee's perspective, from the tax planner, from the auditor itself, or the accountant or the reporting accountant. A lot more work would be done going forward, and it will impact on the trust eventually, whether it's in terms of fees or in terms of what beneficiaries will get. The impacts will be there.
Very nice. Thank you, Rosie. You mentioned something about double taxation. So, Sarah, given the new tax law, is this still something that is possible? I thought with all the clarity, all the lines clearly spelled, everything, it may not be able to repeat or appear. But just help me. Like, is it possible to have cases of double taxation even with this new tax law?
Oh, no. So the clarity that the new tax law has brought into place will now avoid situations where, because of that, maybe not in that collaboration between all these parties where they are spelled out. You could get that maybe the trust that proactively pay certain taxes because it's a way it was due on that day. And then the beneficiary at the point of receiving, or the settlor actually in most cases, is not very conversant with his trust expenses and the fines. And so when the tax authority maybe goes to the settlor, he's not aware that that liability has actually been settled with fees or a trial. And that's where you get those, should I say, lack of clarity or who's to pay what. I mean, what the NTA has done is we spelled out at what point it is the settlor's responsibility. So whether the settlor authorizes trustees to pay on his or her behalf, but there must still be that demarcation when the trustees do it on behalf of a settlor, that those tax remittances reflect the settlor's tax item. If it's a trustee's responsibility that when trustees actually making those tax remittances, it's in the trustees' tax identification number. So That clarity has been provided under the NSA. Now, because administrative wise is what Wesley was trying to speak to. That collaborative effort to understand each person's responsibility and be able to make sure that you're meeting with those timelines and of course the different administrative parts and more. Whether it's reporting before anything. But yes, double taxation it was one of the objectives of the Nigerian tax law to prevent, and that's why it was that consolidation. So you're not having to pay bigger under capital gains tax and then under the first income tax and you start for somebody's pay that they will tax on that same thing. There's now that clarity.
Thank you very much, Sarah. So, thank you, Tech Team. So we're running out of time. We'll move to Q&As now. But before we jump into that one, let me ask just one more question, and this is to trustees, experts here. What are the common misconceptions when it comes to estate planning? Because even though we have been speaking about estate planning till now, we've been speaking about it for a while, so we'll still get confused. So, is there any myth hiding somewhere, any misconception somewhere that you want to quickly call out so that participants can learn from this as well? Ladies first.
So, a lot of people believe that once they write their will or set up the trust, immediately they die. Well, that's actually not the principle. It's not. I think a lot of people need to move their mindset to that. Because at the end of the day, if you're saying that if I write this thing now, I'll pass away, it's a lot better than document all of these things and ensure that whatever thing that you've worked for is being accounted for and is being transferred to your beneficiaries. Another misconception is that once you have real estate planning, it means that you no longer have any funds to yourself. So what that means is everybody believes that once I transfer my assets or once I give trustee the power to manage my properties or everything, it means that I don't have any power. Meanwhile, it's not the case because when a set go, who is the creator of the trust, sets up the trust, you automatically have the power. If you have a revocable trust, you have the power to make amendments. You can decide to take out your funds if you think that you have if you're in need of those funds. Okay. But a lot of people feel that once you do that, you don't have any power to go smart. Okay. So I don't really put too many those are anything to add?
So in terms of myth, there are a lot in that. Then there's so much misconception, even from the way that we plan it and even from the way that we execute it. So for example, I have bought properties in the name of my children who are minors. I think that's an estate plan. It is not an estate plan. For example, I have filled in my copy first trustees, for example, that my younger brother or my older brother is my next of kin. That's not an estate plan. There's also this misconception that estate planning is only for the wealthy, only for the rich people, only for those that have monies.
HNIs.
It is not true. And finally, I will say that many people think that setting or having an estate plan is expensive. Try not having an estate plan and you understand that it's not compared to if you have one. Let me give you an example of estates that have been in court for 60 years.
Sorry? 60
Estates
years.
that have been in court for 60 years. Fighting over what each person is supposed to get. You know, the other thing, it's not okay. So if you say from a polygamous setting, you say, you said the man to marry many wives or marry many husbands. It's just one wife, 4 children, and you see fight for close to 30 years. So having a plan does not mean that you will pay more taxes. Not having any plan at all would even pay you more, you even spend more than you should spend if you don't have a plan.
Yeah. It's interesting. So I have clarity now on I don't have to be an equal to own a trust. very good assurance.
What's about that?
I also don't have to cross over. I also don't have to cross over before that. Or benefit from.
Correct.
You can start meeting.
I can start with whatever it is that I have built. Thank you very much. Okay, let's get into the Q&A chat room now. There are a ton of questions there. I'll read through some of them. Please note, participants, that if you are unable to answer all the questions here, we will collect each and every one of them. We will respond to them. I will make them public via our communication and engagement platforms and channels. So do not be afraid that your question is not picked up. It will be responded to and posted online. So diving into it, I have a question from Spencer Obianope. Visualize this scenario. A retiree in Nigeria owns a trust account. Beneficiaries are the children and trustees passive. I believe that is clear. No expenses, as it were, directly from the trust account. What are the tax implications at the time of distribution to the beneficiaries? Thank you. That's Sarah. You take on over.
Yes. Okay. So, I mean, the specific question was, what will be taxed in the hands of the beneficiary?
Yes.
So, like I mentioned earlier, on, we then look, who are these beneficiaries? Are we speaking to children in any kind of and are they earning below national minimum? It's a yes, to lose to children and infants, and the payout is less than minimum wage children, then no tax, because they have full exemptions.
Okay.
Share below on it. Now, if they are earning a profit, again, are they unmarried children? Who's responsibility to that? And the way the law is written, I'm like, how many children could be actually 40-year-old if you think about it?
Yes, they are children.
But I mean, the intention was children.
Yes.
In fact, so if you're speaking on the context of children, that's not to marry adults, and then it's the settlor that we be deemed to be receiving that payout. And so the settlor will then need to account the taxes. Now, the beneficiaries are, of course, your children and adult homes. So if you receive 20 million, then with that 20 million is seen as an income to you. You then need to do that. Now, it's an income to you as a person. You then look at your own. So if it's a statement of the beneficiary is highly of simplicity, and I receive 20 million from the trust. And then look, what is that? They quickly come and work that year. Do I work somewhere, what employment income? Do I have a property that I earn that income? And bring it all of it to my income, just to make my 20 million. That's going to be my total income. Then look at what are my different expense profile. Whether it's my rental property scheme, whether I have to supervise it, the insurance of the property, if I had an agent, and then look at, am I contributing to pension? Do I have a life insurance on myself or that of my spouse? The different reliefs and deductions, I put them all together to then arrive at what you call a taxable income of their taxing. So you see, for each person receiving the income, you're still able to look at your total portfolio. So that 20 million from the trust, it would just be an income to me as the beneficiary. And then, of course, you go through the whole tax assessment, tax filing, and tax runner.
Okay. Thank you very much, sir. I have a question here that is for works in Okay, just a minute.
Yeah.
How does privacy issues of the trust work under the new tax laws? A settlor may want absolute privacy.
Okay, so as a settlor, you want absolute privacy, ensure that you do not have control over the trust. If you do not have control over the trust, it then means that the trustee has control, and so the trustee will then be responsible for the tax obligations as they relate to the trust. So you can continue to live your life as long as you don't have control over that trust. The trustee has the control. The trustee will take responsibility for all the tax implications as they will explode yesterday. However, as long as you then decide to have children, that means that you obviously that privacy that you wanted to run away from, probably at the end of the day, you will not get that privacy. I know that we have preached, and we still keep preaching, that the trust is a private and confidential arrangement.
Yes.
The new tax law has not changed it. Then depends on you and the sector how much control you want to have over the trust.
Okay. Thank you very much, Rosemary. You want to add?
Yeah, so can you make a clarification here? So even in the case of the confidential tax to make sure that you have that privacy, if the trustee is in charge and has the control and of course, making sure they do the license for taxes. If you have other income outside the trust, that's to your personal allocation. You need to make sure you're applying to bills to place it. Any investment or asset that you haven't put into the trust, if they're generating income, you will still have to file because you get some individuals, they push certain of the assets into a trust, not 100%. Now the trustees are compliant, but then the individual has forgotten it has other non-trust related asset or investors.
So essentially, no where to hide.
Right, a Christian.
Wow. Okay.
Moving on. Not taxing.
Moving on. Very quickly. So let me throw this question to you, Thelma. This is from I'm assuming that's it. Anyways, good day. Is it advisable to withdraw from the trust to a corporate account? I think it's corporate account or individual accounts to reduce tax or not pay tax at all. I think this is even self-fulfilling because Sarah just said
You can't run
you cannot hide.
Because I'm guessing the corporate means the corporate, maybe like the corporation,
Yes.
company. So you will still pay tax. And that's and so there's no you
We're hiding this.
Yeah, your tax rates will just be different, whether you're on a graduated because you're an individual or corporate tax rates being you're a limited. Basically.
But I think, Andy, what we need to emphasize with taxable aid, because I get a sense that people just feel like whatever money that is made, I will just pay tax down, or whatever the assets of the trust. It is not the asset of the trust. To be trading income less applicable expenses before you then think of the tax, and you can then be graduated depending on which side, whether it's individual or this public.
Man, it's a lot of information right here. But you'll pull through with helpful. I think we have one more point to take, if I'm not mistaken.
Yeah.
So let's take the poll and then we will close out on the Q&A and then just wrap this whole session out. I believe we have exceeded the 60 minutes timeline. So let's make it quick. Tech team, could you please put up the poll? Next 30 seconds or thereabouts. Let's get it real quick. Any right or wrong answer, remember, just respond and then we take it from there.
I will stick that not participate.
Yes. Your soundtrack hasn't changed. You gotta participate. Thank you. Okay, tech team, let's roll it up. Can we have a... Okay, so what estate planning tool do you currently have?
And
We have trust, we have will, we have power of attorney, and I do not have an estate plan. Shockingly, but not so shockingly. Excuse me. 54% of the participants do not have an estate plan. 38%, however, have a trust. Well, 6% have a will and just 2% power of attorney. What do you think of this result? Is it shocking to you?
but it's shocking. It's shocking. So the 55% is not a shock.
Okay.
The shock is the 40 something percent, 30 something percent that have professed, and 2%,
6%.
6% for wills,
6% for
and then it's only for
that shock. I would have assumed that it was the other way around. Yeah, you have 30 something percent to be 6% trust. Maybe because we have tapped into the trust working, and so that's why I said we should just be a waste working now.
So I think a lot of people shy away from grabbing a wheel.
Because for me,
Yeah, we can people
Misconception.
say that it's only people that are at the age of 80, 90, or 70 that should have the wheels, right?
those are hardworking
The
states.
young people like us don't have an idea that there are also simple wheels that are catered for so is here and there.
So simple wills and then
Yes.
more comprehensive.
Yes, there's a simple wheel and then there's a comprehensive wheel. The simple wheel for your liquid assets, so your bank account, your pension, your investment, simply. Well, a comprehensive will is when you have your properties, you have your different things, your jewelry, your everything that's aside all your assets. We do it. That's one comprehensive.
Okay, can we evolve from the simple to a comprehensive?
Of course.
So the simple can evolve into a comprehensive.
Yes, you can either do a quarter to top up or you can cancel or take out for
Just
go for you can
and
yes, a brand new will.
yeah.
Okay, just cancel the other one.
Because like as Telma has said, sorry Telma, so when you're for young people, mostly what they probably have are their small investments here and there.
Okay.
As they grow, they mature, they start to acquire assets.
You think
It's then important that you start to think comprehensive.
when
So that's where it comes in. So when you start to have those funny investment, real estate, proceed, right? Then how all these actually told virtual assets, all of those.
that's
It's important you start to think comprehensive.
option. We are running out of time. Thank you very much, your team. Thank you, Thelma. Thank you, Sarah. We're running out of time, so let us wrap this session up quickly. So, parting words from each of us. We started with the babies first, so we'll reverse the case now. So, Rotimi, very short, sharp, direct. What is one thing that you would like the audience to take away from this thing?
I'll say to you, beautiful audience, fear not. I'm not sure it's as bad as you think or imagine. I do believe that with the proper structure in place, this conversation would help you. Remember that for us at First Trustees, our ultimate goal is to help you plan your inheritance without hassle. So tax should not be the basis of the conversation, but just to ensure that whatever plan you have in place, people do not fight over those plans in future.
Thank you very much, Rotimi. Thelma, Jeffrey, parting word.
So I would say, speak to your point of the strategies or choosing professional like First Trustees to guide you on what suits your personal needs and ensure that whatever thing you're coming up with is watertight and doesn't have any kind of complication.
Bring them to a touch.
Good.
So, Sarah, hit us.
I mean, I'm going to flow from what Rotimi and Thelma are saying.
Okay.
Stay away from the myth and come towards the facts. Being aware of what is required of the law will probably delay a lot of cares. To understand whether you're resident or not. Like Thelma said, speak to professional legal needs. In most instances, like Rotimi also alluded to, if you plan properly, you probably won't pay as much as you're paying at realistic. So, I mean, the tax law was structured such that not only if you earn ultra high net worth that you should be concerned, but it's actually ready to be beneficial to most taxpayers. So,
Thank you very much. Thank you very much, Sarah. Thank you very much, Thelma, Rotimi.
So
So, parting word from me. So much further, always teach to us that he always says, he who plans to fail, he who fails to plan, plans to fail. So please, let us plan today. Not tomorrow, not next week, but today. And then planning, please plan with First Trustees Limited. We have Rotimi, we have Thelma here to help guide you through the process so that it is what? Water tight. So from us here, we say thank you. First of all, let me thank the panelists for taking the time to be here. Thank you, Sarah, for sharing your wisdom. Thank you, Rotimi. Thank you, Thelma, for sharing all those things we all on Trustees side. And to those of us online, thank you for spending 60 minutes plus with us. Enjoy the rest of your day and God bless.